Welcome to Web3 Watchdogs, the podcast that takes a deep dive into the world of Web3 security, compliance, and risk. Join Michael Pearl as he interviews executives from across the Web3 industry to uncover the challenges and opportunities of this rapidly evolving space. Web3 Watchdogs is sponsored by Cyvers, your one-stop shop for Web3 security and threat mitigation. Cyvers harnesses the power of AI to eliminate hacks, scams, fraud, and compliance challenges in real time, and even before they happen. For more information, visit cyvers.ai. That's CYVERS.ai.
Hello, everyone, and welcome to the Web3 Watchdogs, the podcast that focuses on everything security, fraud, compliance, policy, and everything that is interesting and related to safety and security in the crypto space. And today we have with us Kevin Wysocki. Kevin is the head of policy at Anchorage Digital. Hi, Kevin.
Hi, Michael. Thank you for having me today.
Happy to have you here. So, Kevin, why don't we just jump right in and you tell us a little bit about yourself, about your background. How did you come to work at Anchorage? And then we can take it from there.
Yeah, that sounds great. So I'm the head of policy at Anchorage Digital. Anchorage Digital is the first and only federally chartered digital asset bank in the United States. There are some state chartered banks, but we're the only ones at the national level that are handling digital assets. I myself worked on Capitol Hill in the U.S. legislature for over 7 years on the House side, which is the lower chamber in the U.S. While I was there, I focused on financial services policy, and in fact, I worked on the Financial Services Committee itself. I was the liaison for the Monetary Policy and Trade Subcommittee, and I also worked for a few members on that committee, most notably Tom Emmer, who's the number 3 Republican in the House, a very strong crypto advocate, and Andy Barr, who is now the subcommittee chair for financial institutions, which is important to our industry because obviously banking is getting more and more involved in crypto. I've also worked at Meta doing government affairs there, and I worked at the law firm Hogan Lovells doing government affairs work for them as well. And now I've been at Anchorage Digital for a little over 3 years.
Great. Just curious, coming from Meta and then shifting to the crypto space, where do you see it more challenging to deal with the Hill, essentially, when it comes to regulation, legislation, and so on? At Meta, that has its own, challenges, or in the crypto space?
I think crypto is a little bit more narrowly focused. Obviously, at a social media advertising company, they're touching a lot of different issues, right? And in many, many jurisdictions around the world. What I do is I focus predominantly on the jurisdictions that we operate in. So the United States, Asia, the EU, and it's a little bit more narrowly focused to digital assets. And one of the nice things is that there's a lot of growing bipartisan support for crypto in DC. We saw that before the election of President Donald Trump with some significant votes on market structure and some crypto accounting things. And then since then, we've seen it too. And I think we're going to talk about this a little bit more, but with stablecoins, there was a terrific vote in the Senate just earlier this week on the Genius Act, where I think 18 Democrats supported it out of the roughly 45 that are in the Senate, and nearly all the Republicans. So I think it's a little bit easier at this point to be working on crypto just because it's a bit more narrowly focused and there's just so much bipartisan support for the industry at this point.
Yeah, that's what I'm keep hearing from my friends and colleagues working on the Hill, lobbying on behalf of crypto. So I totally agree with that. And you mentioned that you basically went from being focused solely on the U.S. You personally, professionally, right? From being focused solely on the U.S. To being focused on the broader, global jurisdictions, right? Asia, EU, and so on. Did I understand this correctly?
Yeah, so I definitely focus the most on the United States, but we have a license in Singapore to do brokerage and custody services. And then we also, in the United States, do the federalist system. We have licensure in some of the states. For example, in New York State, we have a DFS license to do brokerage as well there. And we're always looking to do more and more around the world.
Yeah, so you mentioned that you are a federally chartered digital asset bank. Now, that's a huge statement that I'm sure that some of the listeners are not familiar with all the elements of. Can you please break it down and explain what it means for you in terms of what does it allow you to do as such an entity? What type of services can you provide to your clients and so on?
Yeah, so our federal charter allows us to do custody, staking, settlement, and governance. And we're the only ones in the United States with this specific type of charter. There are a few with state charters that can do some of these services as well. But the advantages of having a federal charter in the United States is that there are certain extra protections that the state regulated entities may not have. The most significant is that we are clearly a qualified custodian, whereas the state chartered entities may not be. And that's an important legal term for institutions like and registered investment advisors that need to use a custodian that's highly regulated and has certain things like bankruptcy protection, so bankruptcy remoteness. So as a federal entity in particular, it's clear in the law that if anything happened and we were to fail, the assets would go to the clients. At some of these state trusts that provide similar services, it's not as clear. They may or may not, in a bankruptcy, these assets may or may not go back to the clients.
Yeah, so essentially what we know from the more retail space or even some B2B space as FDIC, right, if I'm not mistaken, this is basically extended to the digital asset space as well.
So I get, what do you mean exactly? Are you talking about like insurance? Are you talking about like,
Yes. In a sense that if I hold funds in an American bank, essentially, if the bank goes bankrupt, I can receive my funds back and it's federally insured.
no, actually. So there's a difference here because so we're talking about custody. So think of it almost as like a coat check where the assets come in, they sit there, and nothing is done with them. They're not lent out, right? So there's not this kind of fractional reserve banking system where you have with a traditional deposit bank where, you put your money in a checking account, that money, like maybe 10% of it stays there and then 90% is lent out. It's a different system, and that's why there's insurance for that. This is more that you have a safety deposit box. The assets are just held there very securely. So there isn't a federal insurance program in the United States for that type of banking service, whether it's TradFi custody or digital asset custody. But for a nationally chartered bank, there's a specific provision in law. It's 12 CFR 51.8B that says if the bank fails, those assets don't go to the creditors, those assets go to the clients. And that isn't clear necessarily at the state level. And an example of this is in the filings for a lot of the ETFs. They talk about when they use state custody, this potentially could be an issue. So they have to flag this potential risk for clients.
Yeah, so I imagine that users or clients that are seeking such services, such highly protected services, are probably the high rank of the institutionals, right? You mentioned ETFs. Who else are among your clients, if you can elaborate?
Yeah, BlackRock is a client. A lot of the large VCs in this space are clients. Some family offices are. The ETFs definitely are. We also work with a lot of protocols, right? The ones creating the new blockchains and the new tokens. We work with them. I looked it up as well. We work with a handful of Israeli crypto companies too. So we're very much like an international company that works with institutions, and we don't directly work with retail though. For example, the ETFs, ultimately the end user is a retail user. One other thing that's notable too about our federal charter is that we're examined twice a year. And in the United States, generally speaking, the federal regulators have higher standards than the states. There are a few states that are known for really high standards, but not all these states have actually implemented regulations and laws on crypto at this point. Whereas we've been regulated by the federal government since 2021, and they've issued a lot of guidance. And this is particular to the Office of the Comptroller of the Currency, which is an agency under the Department of Treasury that regulates the majority of the U.S. banking institutions. So there's just a lot more clarity, and our institutional clients have a lot of comfort working with us for that reason.
Yeah, so upon custodying funds, I'm guessing that your clients or any other client that has a need for custody, they have some concerns. So obviously you've mentioned that the fact that you are a federally chartered bank, this covers the concern of you unfortunately going bankrupt and then have to reimburse, or rather have to allocate the funds and prioritize them to the clients. That's settled. But what about security? concerns, because obviously that is something that cannot be exaggerated. And I'm speaking for personal experience here at Cybers. What type of security measures do you have to implement in order to safely custody those funds?
That's a great question. So at Anchorage Digital, we definitely consider ourselves as a security company first, right? And a crypto company second. Our founders were both security engineers, and they actually started the company because they had a number of people coming to them and like, hey, I lost my keys. Can you help me recover my Bitcoin, right? So security is first and foremost when anything we design with custody solutions. And maybe one of the strongest controls at the very beginning we have, and this is mandated due to our federal charter, is KYC, right? We want to know exactly who our customers are, the counterparties that they're working with. What type of activities are they going to be doing, so we can kind of see the patterns. What also is like the I guess at another level we have biometric like identification standards, right? So like visual authentication, right? Voice authentication, right? We geofence. We know the device, right? And then we're using a number of tools to help us kind of notice these potential patterns. And if anything seems off, we can contact our client, be like, hey, are you sure you want to do this? So we have employees that actually manually check everything after we use all the tools to confirm that. And on top of that, we hold the keys ourselves. Our clients actually don't hold the keys. Our keys are stored in HSM that's offline. But unlike cold storage, it's very fast. We can execute a transaction in about 15 minutes, presuming that the client meets the quorum requirement, right? It's not just one person that says yes to this. It's a handful. Then we manually check. And I think this is one of the things that's very beneficial, is that we can ultimately provide the check. Like, are you sure you want to do this? Okay. All right. Everything looks good. Then we'll broadcast it to the blockchain.
Yeah, that always amazes me. We saw it in the Bybit hack, but in other cases as well, that some of them were not even public yet, that basically you see huge institutions, huge centralized exchanges, but in essence, they work like banks holding, funds of their clients that have very, very limited and very kind of simplified security measures. So it's very encouraging to hear you say that. One other concern that probably not your clients have, but perhaps you have as a company that is under the lens of the regulator, is probably compliance. Given the fact that you're receiving funds, and you're receiving huge funds, obviously in the billions from your clients, those funds, their origin is something that is obviously on your mind. How do you cope with that? What kind of tools are you using? What kind of procedures?
Yeah, this is actually really neat. So again, our regulator is the Office of the Comptroller of the Currency, and they examine us twice a year. One of the things that we worked with them on is to develop a deposit attribution tool. So when the funds come in, we require our clients to tell us information about where those funds came from, right? And they can't move those funds until they do that. So effectively, those funds are locked until that point. So this is one of the ways in which we are making the system safer, right? We're figuring out where those assets are coming from. And then from there, if they want to move those assets, we can do that for them. And then, of course, it's the KYC on the front end, knowing our clients to begin with, and then using all the latest and greatest tools that are out there and available to everyone. And then, of course, regularly speaking to the government, to industry about new and emerging threats, and evolving our capabilities from there.
And is it something that I'm going back to the Hill, right? Is it something that you hear from the legislators and the regulators with respect to their concerns? Because obviously we all know that crypto at least had quite a reputation with respect to both security and compliance. And probably, and I keep watching, the footage from the Hill, and you see all those debates, and some of the legislators are very skeptical about it. Do you hear that from them as well? How do you deal with such claims?
Yeah, so it's obviously central to both of the major bills that are before Congress, which is stablecoins and market structure. Both of them have provisions in them related to custody and how that should be done, and then also BSA AML requirements too. Basically, both of those bills require BSA-like requirements on entities participating in crypto, with some exceptions and tailoring for the specific type of entity And the tailoring will typically be done by the agencies. Congress is kind of doing the broad strokes of what this should look like. And then the actual regulators will jump in and write the rules and guidance associated with that. So it's definitely front and center in all of the debates. We're very, very pleased that that is being incorporated into these bills. We think it's going to lead to more institutional adoption of crypto. Already this year, we're seeing just about basically all the major players in TradFi at least dipping their toe in the water of digital assets, and some are diving right in. And I think part of it is the confidence that DC is really working on these issues. And one of the largest components is the compliance and the national security pieces.
Got it. And going back to stablecoins, which you've mentioned, stablecoins are probably one of the fastest growing segments of the Web3 space, and we see the usage growing in so many ways, both institutional and retail. Can you give us more clarity on the type of services that you provide to the stablecoin? I'm guessing issuers, but there are also other players that people usually don't know of, because it's an entire ecosystem of companies that are supporting the stablecoin industry. So maybe you can explain a little bit about, how this is comprised and where does Anchorage fill it in?
Yeah. Yeah. So I would say in the United States, there isn't currently a federal pathway to issue stablecoins. You have to cobble together state licenses that weren't originally designed for the issuance of stablecoins, right? And it works, and this is how some of the issuers do it. But what the goal of these bills that are out there, and one looks like it could definitely pass very soon, the Genius Act, are to create that federal pathway and these minimum standards for everything. So when you're kind of dissecting these bills, and this is maybe a good way to kind of get into like every like kind of subgroup within there, you have the issuers, right? They're very significant, and you can have a bunch of different types of issuers. You can have fintechs, you can have banks, you can have state banks, you can have federal banks, right? And then you have to also think about, well, where are the reserves held, right? Who's holding these reserves? And that is going to be handled by, in practice, it's going to be held by what are called qualified custodians in the United States. So banks, some broker dealers, and some foreign banks, right? So that's an important part of that. And then, of course, the exchanges are a large player in the stablecoin space as well, because as you know, stablecoins are used to trade for various digital assets and all of that. So those are some of the major players, and you're right. I think the market cap right now is about 250 billion, and I think we could easily see that market cap in the trillions, especially if this legislation passes. And I don't know if you saw, but just last night, President Trump posted that he wants the Genius Act, which is the Senate stablecoin bill, to be enacted into law ASAP without adding anything to it, without making any changes. There was some thought that maybe market structure would get tied to it, and he's saying no. So it'll be really interesting to see if the House takes him up on that and moves it expeditiously, possibly even in the next couple of weeks.
So maybe you can zoom into that and give us kind of in layman terms how the stablecoin ecosystem in the United States is going to look like before and after the Genius Act. What does it bring to the table? What will it enable to the companies and to the ecosystem?
I think the biggest thing is it's really is the clarity. I think you're going to see that the TradFi institutions, from banks to some of the technology companies, are going to dive in on this. We're already hearing about that. There was an announcement that JP Morgan and a handful of other banks are going to create some kind of stablecoin. Talks about a number of other institutions doing the same thing. And then I think like the crypto natives, I think you're going to see a lot of them do that. Already right now, we are a co-founder of USDG, the global dollar, with Paxos. That's issued out of Singapore. And a couple other crypto companies are involved in it as well. I think you're going to see a number of new stable coins that come out there. I think, for example, with US global dollar, I think that's going to have to comply with the US standard, right? So you're going to see foreign issuers like that, potentially others come to the United States, which I think is a real win, I think, for stablecoin users, and then for the long-term prospects of stables in general to be used in payments, right? And really potentially transform the payment systems that we're used to. And another neat thing, depending on how this all works out, is I think with stablecoins, eventually more people are going to be able to access the risk-free rate and get that like 4 to 5% that at least right now in the United States is hard to come by unless you park your money in a high yield savings account. The bill actually explicitly doesn't allow issuers to provide rewards like that at this point. But I think over time that's going to be worked on. So I think that's something that's like just a real big win for, your average person. They can have access to that type of reward.
So in essence, you will be able to basically deposit your stablecoins just like you do with your USDs and get an interest rate on that, right?
I think eventually we're going to get there. Yeah, I think it's going to create a very competitive market for rewards or interest or yield, which is I think a win for the ultimate, like the end user.
Yeah, it's funny because the notion like 2 3 years ago was, that crypto is going to compete with the US dollar. But now you see, and I think that that's why President Trump is so bullish on that. And that's my humble opinion, is because essentially he understands that when you have this, embodiment of the dollar digitally, right? Even if it's different issuers and so on, it doesn't really matter to the US, on the grand scheme of things, because at the end of the day, people are depositing USDs in to the issuers, and then the issuers are basically providing the liquidity for the crypto space. But at the end of the day, it's still a usage of the US dollar. So I think that it's not only a minor kind of niche fast adopters issue. It's the next level of the US economy, and something that is going to add more power to it. What do you think?
Absolutely, 100%, right? I think David Sachs, that's the crypto czar in the United States, was saying the same thing just last night on television, talking about how it's going to lead to more people buying US treasuries. It's going to make it easier to export US dollars around the world. So yeah, stablecoins really provide that opportunity, and that they're one of the digital assets that maybe everyone talks about Bitcoin and stuff, but this is a way that actually the US dollar is going to proliferate.
Yeah, and going back to the custody issue, I read recently that Anchorage had an opinion, or rather a more backed opinion, that you should separate between the custody and the trading, right? And when you look at the exchanges, for instance, in essence, they're doing the custody and the trading. Definitely, you can claim that part of the funds are being custodied with third parties, right? But
Mhm.
when you look at the general structure of the exchanges, they are doing both. And from what I understand, it's not healthy. Maybe you can explain why.
Yeah, that's right. We think there should be functional segregation of custody and exchange activity. I think that is a concern. We saw with FTX, there really wasn't a check, right? And possibly if they had a different entity, a third party providing the custody, maybe that wouldn't have happened. But yeah, and this is the thing, like some of these exchanges, they may have a trust, right? But they're not using the trust for the custody of the retail clients on the exchange in most circumstances. So the customer's assets are held in one big or a few big wallets that really are like honeypots, right? And if those are hacked, those assets could be stolen pretty easily. But the nice thing is that the blockchain can actually solve for this with a couple other technologies as well. We are one of many companies that have a solution for this, where you can actually use a bank for the custody, and just with APIs you can put a hold on the assets, and the exchange can do this, right? And then you can settle instantaneously, and those assets never need to be pre-funded and into these big omnibus wallets on an exchange. I think it's a good consumer protection to have, and the technology's there. I'm hopeful that that will be adopted in market structure legislation over time. Currently, in the House of Representatives, which is one of the legislative bodies in the U.S., there's a bill on market structure called the Clarity Act, and it sets some standards for digital commodity qualified custody. And it's a good starting point, but there are also exemptions built in there where exchanges can continue to do custody themselves and not even have to use one of these new kind of created qualified custodians just for digital commodities. They can get an exemption. So I think that's something that the Senate probably is going to work on quite a bit. The Senate recently did a lot of work on the stablecoin bill. I think enhanced that bill quite a bit, and it looks like they're moving the ball down the field, and I think ultimately going to get that enacted into law probably by the end of the year at the latest, and maybe much sooner than that, hopefully in the coming weeks. Whereas market structure is a much heavier lift and much more difficult. just because it's so complicated. And if you look at even the bill text, it's like 250, 300 pages, whereas the stablecoin bill is more like on the order of 130 pages.
Yeah, and I wanted to ask you, given the fact that you are, as we've mentioned several times, a bank, one of the biggest challenges that we hear from crypto companies, obviously the smaller ones are feeling the heat to a larger extent, but even the big ones have challenges with working with banks. Essentially, they need to hold their fiat somewhere. They need to have their on ramps, off ramps, and that is something that crypto companies are finding much, much more complicated and much more challenging. At the end of the day, when you are a large bank, your crypto companies, crypto related companies are only a small fraction of your clientele. And at the end of the day, there is a tension between you wanting to onboard clients and to retain them and taking risk and whether it's worth it. So what's your take on that trend? Will it change? How can it change? Because that's something that I'm hearing from quite a few crypto companies.
Yeah, in recent years, debanking has been a huge problem for industry. And ironically, even though we are a bank ourselves, we needed fiat banking rails. And some of the banks weren't providing us services anymore. It was very unfortunate. Thankfully, though, things are changing. There was an executive order put out by the new administration. Many items related to crypto emphasized that we needed to fix debanking, and the regulators in the United States that have jurisdiction over banks have taken a lot of self-corrective actions on that already. There are a couple significant ones. One is they pulled a joint guidance from the three banking regulators that previously warned banks of banking crypto entities. Now that's gone. That's really significant. There was also guidance from two of the banking regulators in the United States saying that basically you can't participate in any crypto project unless you get permission from the regulator, but the regulators weren't giving the permission. Both of those agencies have pulled back that as well. So it's very significant. In fact, our founder testified before Congress about this very matter. It was an unfortunate period of time, but I'm hoping that that's behind us. I'm also hopeful that we will get legislation that codifies into existence that you can't do this. There's a bill out there called the Firm Act. The Senate Banking Committee Chairman Scott is the sponsor of that. And then in the House, it has bipartisan support between Torres, who's a great member, a Democrat member from New York State, and Andy Barr, actually my own old boss from Kentucky. So we're hopeful that at the agency level, they can fix this. And then on the back end, there could be a follow-up with a legislative fix as well.
Sounds good. So we're approaching the end of the show. And before we wrap up, I would like for you to kind of zoom out and gaze into the future, because what we've seen, in my opinion, during the last 2 years is kind of the institutionalization of crypto, right? We had the ETFs that were approved one by one, and that obviously gave a huge boost to, institutional crypto, and eventually funds were flowing into BlackRock and all the other ETF providers. Now with the Genius Act, we're going to see much more leeway with respect to stablecoins, and we have a bunch of other both regulations, and also we see institutions that are being set up. You mentioned JP Morgan wanting to issue their own stablecoins. So both from the regulatory point of view and from the business point of view, crypto is becoming much more institutionalized. My question to you, and by the way, the other trend that you see is that DeFi is to some extent declining and becoming, not that big of a thing like it was, let's say, 2 years ago during the previous bull run. So my question to you is, looking forward, do you think that this trend will continue and eventually crypto will become just another asset class like commodities like gold and so on? Or do you think that there is still room for kind of the retail, maybe even kind of revolutionary, challenging the system crypto?
Yeah, I think there is still room for both. I think recently, because of the regulatory changes, you are seeing more institutional adoption. And I think we should welcome that. I think that is good. There are a lot of things that can enhance our current systems, basically better payment plumbing, better banking plumbing to the system, all those things. But yes, kind of the independent spirit of crypto, right? We need to keep DeFi. And we work with a number of protocols that are working on these things, right? Building a better mousetrap, building a better blockchain, right? That it can do more and more. So we absolutely need to be able to let both grow and prosper. The market structure bill does have some DeFi provisions and some studies on that. We need to make sure that while that thing continues to evolve and move through Congress, that nothing in it harms DeFi. At times, there are some real concerns with provisions that have been added to market structure bills that could have been highly problematic. We've also been able to push back effectively. At the end of the last administration, there was a broker disclosure rule specifically that affected DeFi. Congress actually was able to overturn that at the beginning of the new Congress. So it's definitely something that folks like me who are lobbying on these issues are paying close attention to. And we've had some recent wins that maybe aren't made as public, but we're definitely defending the DeFi space while also excited about the potential for institutional adoption of digital assets.
Interesting. So basically, there's room for everyone, right? You can grow the institutional space and the DeFi space as well, and
Absolutely.
they will feed into each other and will grow together.
Yep.
Great. Kevin, on that note, thank you so much. Maybe you can share, are you active on social media? Where can we read more from your work and so on?
Yeah, I'm active on X. My handle is just Kev Wysocki, and I post on there a couple times a week about things. So that's probably the best way to see what I'm thinking through social media.
Perfect. Kevin, thank you so much.
Yeah, thank you, Michael.
Web3 Watchdogs is sponsored by Cyvers, your one-stop shop for Web3 security and threat mitigation. Cyvers harnesses the power of AI to eliminate hacks, scams, fraud, and compliance challenges in real time, and even before they happen. For more information, visit cyvers.ai. That's CYVERS.ai.